Well, let's get across the market open. Marcus Padley joining us from Marcus today. Marcus, welcome to Wednesday as we, of course, rapidly approaching Christmas. Talk of a Santa rally, whether that's going to be on or off. How are we set up, do you think, particularly given perhaps fears about an AI bubble have dissipated somewhat?
They certainly have. Although I'm looking at the market charts. We've had 5 good days, which was last week. I remember writing Friday a week ago that I was utterly convinced we'd done the right thing being in cash. And then by the next Friday, I'm thinking, goodness, maybe we should be buying something. But all that really happened last week was the chances of the Fed cutting rates has increased. And we've got the Fed meeting next week. And that has driven the market, and it's driven everything. I've got a chart in the newsletter this morning, which is the correlation between BHP and the Nasdaq. Everything has dropped at the same time, and everything's bounced at the same time, even though they're unrelated. So we're dealing with a lot of sentiment at the moment because that's the underlying similarity between everything. As far as where the market goes in December, I take absolutely no credence to seasonality in the market. November was supposed to be the best month. It was one of the worst. And so where there are numbers, there are statistics. So December's not going to be a good month just because on average over the last 20 years, it was the second best. As far as the AI bubble's concerned, nothing's changed there. Might sound silly, but we've come off from October the 10th when Nvidia was in the middle of a crazy AI Super Bowl conference and billion-dollar circular deals were everywhere, and it was frenzied. To now finding Gemini 3, Alphabet's AI model is a competitor. It doesn't use Nvidia chips. And Meta's buying their chips. The whole AI bubble hasn't burst, but it certainly leaked some air. But if you look at the numbers, even despite coming back a bit, the PEs are still right up there. The PE, even the forward PE, is still over 30 times. If it was to come back to 22, 25 times, the long-term average is 18 times on the Nasdaq. If it came back 22, 25 times, you're looking at a 20% drop from here. So it's still inflated. It hasn't burst. The Fed has just saved us in the short term, or Fed hopes have just saved us in the short term. It's not, I think we can still be suspicious of the trend despite last week.
You talk about sentiment. Is Bitcoin an accurate reflection of what we're seeing more broadly at the moment, given it's been incredibly volatile and obviously some 30% off its highs in early October?
Andrew, that's okay. I wrote. No, I was after Bitcoin fell 8% yesterday. I was thinking if that happens again, there is nothing to support it. If you lose money, if I lose money in a fund and by investing in a Bitcoin ETF, and one of my investors says, why did you buy it? I've got absolutely no excuse. There's clearly, I don't want to be a crypto critic, but there is no integrity to it. Mind you, there's no integrity to gold really, but there's no integrity to it. And what happened, the whole complex peaked on October 10th when Trump did that tweet about 100% tariffs on China, and you had that crypto crash. Since then, Bitcoin, which is the cryptocurrency with the most integrity, is only down 32.4%, less whatever it's bounced today, 6%. But the other, a measure of the secondary cryptocurrencies is down 70%. I've started writing an article today. I don't think I'll publish it because Bitcoin's up 6%. But if you want to know what happens when something happens, take it to an extreme. So I ask, what would happen if Bitcoin went to zero? And then there are all sorts of grey grades of that on the way. But if Bitcoin went to zero, some companies have gone out backwards, and balance sheets would get Swiss cheese in them, and suddenly everyone exposed to a Bitcoin balance sheet would be under suspicion. Credit markets would freeze. We'd have another global financial crisis. So it's sort of happened in some of the secondary digital asset markets. And we've got to be very careful Bitcoin doesn't evaporate here. It sort of could. So it's not just a barometer of sentiment. The recent performance has told you that there are credibility issues that go quite deep in crypto. Fear could accelerate very quickly. So it's just confirmed to me I just can't buy anything crypto for my investors because it's a dangerous space still.
Now, Marcus, just in terms of perhaps emerging risks, certainly there's a lot of focus on the next Fed chair. I think Donald Trump has, in fact, given it away, hasn't he? Talking about Kevin Hassett, and he was in the room when he said the next Fed chair is in the room with him, but he didn't actually name him. What does that do? What does the market concern about, just as far as if he were to be appointed, what it does for Fed independence?
Well, as we've found out, Andrew, the Puritans have raised mighty hell about the Fed independence. But the reality is the market quite likes the idea that we're going to get probably Stephen Moran on the Fed board. I assume he's going to be re-nominated next year. If we get Kevin Hassett as well, both of them are calling for 50 basis point rate cuts. Other Fed governors are sort of filing in behind if they know what's good for them. And whilst everyone, not everyone, but whilst there is this issue of Fed independence and how terrible it is, let me just tell you, the Fed have done a pretty hopeless job over the last 20 years, keeping rates too low, creating a mortgage-backed security balloon which blew up. They caused the GFC. They then handed money to Wall Street, which was supposed to reflate the economy, and all they did was invest it and make billions for themselves. They kept loose money for too long. And then in COVID, they've told us inflation was transitory and ended up raising interest rates from 0.5% to 5.3% in a period of 18 months. You know, they're pretty bloody hopeless. And they could do with a shake-up, and whether there's some moral issue about the integrity of the Fed and being touched by Trump, maybe something radical needs to happen to change their modus operandi, because they are not very good at their job. So I think the market's also far more focused on rate cuts as a positive than Fed independence as a negative.
So, Marcus, to your positioning then, you're still 100% cash. You were talking about earlier there, perhaps you had some doubts. Are you still committed?
We're still in cash in our strategy portfolio and our MT20 real portfolio. So we've got currently $86 million sitting in cash, waiting to go. I was utterly convinced Friday a week ago that we've done the right thing. We've timed it fabulously. And then we had last week a rally on the back of the Fed. Our job, I think, is to buy things we're excited about, that we are convinced are going to make money, rather than just getting back in the market because it doesn't look like it's going to blow up. So for the moment, we're still sitting in cash. We have got the Fed meeting next week. I'm fearful that the Fed are dovish. They might still be hawkish because they've still not got a full data set, so they might be still in the fog. But if the Fed are dovish and they cut rates and the market starts to focus on that, there aren't a lot of negatives out there at the moment, it has to be said. A lot of the scary bits have gone mild, but our game is to buy Australian ETFs that are going up. So our job is to look through them and find ETFs that on a risk-aware basis are going to make our investors money. At the moment, it's not obvious. Things are still essentially, they've topped out. Despite this week, we're still in the downtrend. We haven't broken it yet. We'll just stick in cash, but we're doing a lot of work in the background trying to work out whether there's something we can get excited about.